Picture this. While everyone's chasing the latest AI hype stocks trading at hundreds of dollars per share, some of the smartest money is quietly positioning itself in overlooked companies trading for less than the price of your morning coffee. Today, I'm pulling back the curtain on two stocks under $6 that have the potential to deliver returns that could make your portfolio very happy. These aren't speculative moonshots or pump and dump schemes. These are real companies with tangible products, revenue streams, and catalysts that Wall Street might be sleeping on. So, if you're ready to discover opportunities that your broker probably isn't telling you about, stick around because what I'm about to share could be a game changer for your investment strategy. Before we dive into the specifics, let's talk about why penny stocks under $6 deserve a place in your consideration, especially in today's market environment. The beauty of these lower priced stocks is the asymmetric risk reward profile they offer. When you're buying a stock at $3 or $4, you don't need a miracle for it to double. You need execution, you need catalysts, and you need patience. But the potential upside can be exponential compared to buying a mature company already trading at all-time highs. The key is separating the wheat from the chaff, finding companies with real fundamentals, not just lottery tickets. And that's exactly what we've done with today's picks. Our first company is Processa Pharmaceuticals, trading under the ticker PCSA, and it operates in one of the most exciting and potentially lucrative sectors in the market, biopharmaceuticals. This is a clinical stage biopharmaceutical company focused on developing next generation drug products that improve patient outcomes and reduce overall healthcare costs. What makes Processa particularly intriguing is their innovative approach to drug development. Rather than starting from scratch, they're taking existing compounds with known safety profiles and improving upon them. This de risks the development process significantly because you're not dealing with completely unknown molecules. The safety data already exists, which can accelerate timelines and reduce costs. Let's talk about their pipeline because this is where things get really interesting. Their lead product candidate is designed to address a significant unmet medical need in oncology. We're talking about a multi-billion-dollar market opportunity here. The drug has already demonstrated promising results in earlier clinical trials, showing not just efficacy, but a safety profile that could give it a competitive advantage over existing treatments. What's particularly compelling is that this isn't just one shot on goal. Processa has multiple programs in development, diversifying their risk and multiplying their potential paths to success. Now, let's dig into the financial picture because this is crucial for any investment decision. Looking at their most recent quarterly report, the company is in a strong cash position relative to their market capitalization. They've been strategic about capital raises, bringing in institutional investors who believe in the long-term vision. Their burn rate is manageable, and based on current cash reserves, they have sufficient runway to reach critical value inflection points without immediate dilution concerns. This is absolutely critical in the biotech space where cash is king, and running out of runway can devastate shareholder value overnight. The management team at Processa deserves special attention. We're not talking about first-time entrepreneurs or academics playing business. The leadership team has decades of combined experience in drug development, regulatory affairs, and commercial strategy. They've been through successful drug approvals before. They understand the FDA process, they know how to navigate the complex landscape of clinical trials, and they have relationships with key opinion leaders in their therapeutic areas. This experience cannot be overstated in value because it dramatically increases the probability of successful execution. What really caught my attention recently were the strategic partnerships and collaborations Processa has been announcing. They've entered into agreements with contract research organizations that are top tier in the industry, ensuring their clinical trials are conducted to the highest standards. More importantly, they've been engaging with regulatory authorities proactively, which suggests they're positioning themselves optimally for eventual approval pathways. The fact that serious institutional investors and strategic partners are willing to work with them speaks volumes about the credibility of their science and business model. Looking at the upcoming catalysts for Processa, we have several potential value inflection points on the horizon. Clinical trial data readouts are expected within the next several quarters, and positive results could send this stock significantly higher. There's also the potential for partnership announcements with larger pharmaceutical companies who might be interested in their platform or specific assets. These types of deals can provide non-dilutive capital, validation of the science, and access to resources that can accelerate development. And of course, there's always the possibility of acquisition interest if the data continues to impress. The risk factors for Processa need to be acknowledged because I believe in giving you the complete picture. Clinical trials can fail. That's the nature of drug development, and even promising early data doesn't guarantee success in later stages. Regulatory approval is never certain, and timelines can extend beyond expectations. The biotech sector is inherently volatile, and investor sentiment can shift rapidly based on trial results or FDA decisions. However, when you balance these risks against the potential rewards and the current valuation, Processa offers a compelling risk-reward profile for investors who understand what they're buying and have appropriate time horizons. Now let's transition to our second opportunity, Udemy Incorporated, trading under the ticker UDMY, which comes from a completely different sector but is equally compelling for very different reasons. Udemy operates in the digital education and skill development space, an industry that has fundamentally transformed over the past several years and shows no signs of slowing down. This is a global marketplace connecting millions of learners with instructors across virtually every subject imaginable. What makes Udemy's business model so attractive is the network effect. The more instructors who create content on the platform, the more learners are attracted. The more learners who join, the more attractive it becomes for instructors to create content. It's a virtuous cycle that creates a powerful competitive moat. Let's examine their business fundamentals because, unlike our biotech play, Udemy is a revenue generating company with a proven business model. Looking at their recent quarterly performance, we see consistent revenue growth across multiple geographies. They're not just a one market wonder. Udemy has significant presence in North America, Europe, and increasingly in high growth emerging markets. Their course catalog spans thousands of topics, from technical skills like programming and data science to creative pursuits and personal development. This diversification means they're not overly reliant on any single category or trend. The financial metrics here tell a story of improving operational efficiency. While Udemy has been investing heavily in growth, which impacts near-term profitability, the unit economics are moving in the right direction. Customer acquisition costs are being managed carefully, and more importantly, customer lifetime value is increasing. This means that each dollar they spend acquiring a new learner is generating more return over time. Their gross margins are strong, typical of digital platform businesses, where the incremental cost of serving an additional customer is minimal. As they scale and achieve better operating leverage, there's a clear path to sustained profitability. One of the most exciting aspects of Udemy is their addressable market. The global e-learning market is projected to reach hundreds of billions of dollars in the coming years, driven by several unstoppable trends. Remote work has made skill development more important than ever. Career transitions are becoming more common, requiring people to constantly upskill. Traditional education is expensive and often doesn't keep pace with industry needs, creating massive demand for flexible, affordable alternatives. Udemy is positioned right in the middle of these massive secular trends. Their recent strategic initiatives demonstrate management's understanding of where the market is heading. Udemy has been investing in artificial intelligence and machine learning to improve content discovery and personalization. When you have millions of courses and millions of users, helping people find exactly what they need becomes both a challenge and an opportunity. Better recommendations mean higher engagement, higher completion rates, and ultimately higher revenue per user. They've also been expanding their enterprise offering, Udemy Business, going after corporate training budgets, which represent a massive revenue opportunity with higher price points and better retention. Partnership announcements have been particularly interesting lately. Udemy has been forging relationships with major technology companies, universities, and certification bodies. These partnerships add credibility to their offerings and create pathways for learners to gain recognized credentials, not just certificates of completion. When your courses can lead to industry recognized certifications or even academic credit, the value proposition becomes significantly stronger. This positions Udemy not just as a nice to have learning platform, but as a critical career development tool. The competitive landscape is important to understand. Yes, there are other players in online education, but Udemy has built something difficult to replicate. Their instructor community is deeply embedded, their content library is vast and constantly updated, and their brand recognition in the space is strong. While competitors with deeper pockets exist, the marketplace model creates switching costs and network effects that provide protection. Plus, the market is large enough that multiple players can succeed, and Udemy has demonstrated its ability to carve out and defend its position. Looking at the valuation, this is where things get really interesting for value-oriented investors. The stock has been under pressure recently, not because the business is failing, but due to broader market sentiment around growth stocks and concerns about consumer spending. This has created what I believe is a significant disconnect between the stock price and the underlying business value. When you look at their revenue growth, market position, and long-term potential, the current price seems to offer an attractive entry point for patient investors willing to look past short-term noise. Upcoming catalysts for Udemy include quarterly earnings reports where management can demonstrate continued execution on their growth strategy. Any acceleration in enterprise revenue growth, particularly in the Udemy business segment, would be particularly well received by the market. There's also potential for new strategic partnerships or acquisitions that could expand their capabilities or market reach. As sentiment around growth stocks improves, which historically happens when investors become more confident about economic conditions, Udemy could see significant multiple expansion from current levels. The risk factors for Udemy need acknowledgement as well. Competition is real, and well-funded competitors could pressure margins or market share. Economic downturns could impact consumer spending on education and corporate training budgets. Technology platforms face constant pressure to innovate and stay relevant. Changes in consumer preferences or the emergence of disruptive technologies could challenge their business model. However, when you balance these risks against the potential rewards and the current valuation, Udemy offers an attractive opportunity for long-term investors. So there you have it, two stocks under $6 that deserve serious consideration. For your portfolio, Process AA Pharmaceuticals in the biotech space with their innovative drug development approach, and Udemy in the digital education revolution. As always, do your own due diligence, understand your risk tolerance, and never invest more than you can afford to lose, especially in volatile small cap stocks. But If you're looking for opportunities that offer asymmetric upside potential and you're willing to accept the inherent volatility that comes with it, these two companies represent the kind of opportunities that could generate substantial returns for patient investors. If you found this analysis valuable, make sure you're following for more deep dives into overlooked opportunities in the market. Until next time, happy investing and may your portfolio prosper.